Oh boy, there is a lot to unpack here. As you can imagine, as soon as Musk tweeted this out, the price of Bitcoin just tanked. Hey everybody, Walrus here from Walrus Street, bringing you your news and earnings for the week of May 17th, 2021. Just a reminder, I am not a financial professional. All information in this video is for entertainment purposes only. So for the most part, this week in the stock market sucked. It was horrible, everything was red. Wednesday and Thursday were particularly bad because of the CPI report, which we're going to look at in a moment. Friday was a bit of a recovery. It was kind of a refreshing green day. It was one of the largest single day broad market gains that we've had in a really long time. And that's all well and good until you kind of zoom out and you realize that a 5% recovery day when you're down 18% for the last couple weeks on a lot of your positions it's not really that great. But it was at least a positive ending to the week. This week kind of had me thinking about that old adage, sell in May and go away. Of course, another adage is time in the market is better than timing the market. So you've got this like fighting of stock market idioms. It's all stupid. With all the red days that we've been having, I've been wondering if the sell in May and go away thing isn't sort of a self-fulfilling prophecy. So many people kind of follow it and they believe it that they sell, which causes stock prices to go down, which causes other people to panic sell. And then it ends up kind of creating the cycle where somebody at one point said sell in May and go away like 60 years ago, and it's just worse and worse and worse over time. It's just a thought I was entertaining in my head this week. Either way, let's get started with the news. Here's the big reason for the stock market drop on Wednesday and Thursday. This was the Bureau of Labor and Statistics CPI report. This is the Consumer Price Index. And the Consumer Price Index is typically responsible for letting everybody know about inflation because it reflects consumer prices, the retail end prices for a lot of goods and services. This was released at 8:30 a.m. on May 12th. Coincidentally, that's exactly when the market started tanking, Wednesday and Thursday. This report ended up leading to 2 days of declines as all of the news outlets were talking about hyperinflation, hyperinflation, hyperinflation. You know, for a long time, our target inflation has been right around 2%. And the CPI report revealed inflation of 4.2%. The CPI for all urban consumers increased 0.8% in April after rising 0.6% in March. Over the last 12 months, the all items index increased 4.2% before seasonal adjustment. This is the largest 12-month increase since 4.9% for the period ending September 2008. Anytime anybody investing sees 2007, 2008, 2009, you think great financial crisis where just a whole bunch of stuff went to shit at the same time. But that was the last time that we've seen inflation levels this high. A couple of interesting points here. The index for used cars and trucks rose 10% in April. This was the largest 1-month increase since the series began in 1953. If you remember, I actually touched on this last week when I was talking about Shift and their earnings report. And we're going to cover their earnings report today because it was actually so phenomenal that I think it should be bigger news than it is. And that's not like me speaking as a stockholder. Like objectively, this earnings report was one of the most fantastic ones I've seen. So this food one right here, 2.4%, is probably one that most people are noticing. That's a pretty substantial increase. Also, energy, gasoline is up. Electricity is up 5%, which is definitely noticeable on your electric bill. These are the 12-month figures, by the way. Also, used cars and trucks are up 21% in the last 12 months, including 10% in April alone. So these numbers are all really substantial. Food and energy, which are arguably the two largest expenses for people outside of their rent or mortgage or their housing. So these are numbers that people are going to be feeling in their bank account. This is the reason why the stock market kind of tanked when you see this big, scary 4.2% inflation figure across all items in the index. Now, the CPI is not a perfect measure of inflation, but it is moderately reflective. If you want to know what I mean by that, this is a fantastic read, like hands down the best thing I've ever read on Seeking Alpha, which I don't even like Seeking Alpha, so that doesn't mean a lot, but this is truly remarkable. The author is Alden Schwartzer. She's the author of Stock Waves, High Probability Investing, where fundamentals and technicals align. This is extensive. You can go through this. I'll include the link below. This took me probably an hour to read and really understand. She says the CPI is not entirely correct. It's not entirely accurate. And she went and back tested and analyzed 150 years worth of prices to come to this figure. She also doesn't see good evidence that real inflation has been 2 to 3 times higher than CPI reports, as some people have suggested. If you haven't seen anything about that, there's people on the hyperinflation bandwagon that are saying the CPI levels are being artificially reported and they're actually 2 to 3 times higher. This economist is saying that's absolutely untrue. One of the main discrepancies she sees in the CPI report is that due to offshoring, exports, manufacturing overseas, and automation, combined with a rather high broad money supply growth, can't imagine why the broad money supply is growing. Brrr. We've been in an environment where some categories have seen rapid price deflation while others, often more essential categories of goods and services that haven't been automated or outsourced, have risen in price faster than the broad CPI. Plus, wages have barely kept up with inflation, and while she's saying inflation isn't super high, wages still aren't keeping up with the 2% inflation per year, which is compounded by the fact that more education and thus more student debt is required on average to get those same inflation-adjusted wages. In other words, on an inflation-adjusted and education cost-adjusted basis, median wages have decreased. This is a really fantastic read. If you want to understand more about the mechanics of inflation and 150 years of history of inflation, like I said, go ahead and check out that link below the video. And she also highlighted there in the conclusion that other categories of more essential goods, that would be our gasoline, our food, those are more noticeable to inflation. The price of a computer has gone down over time. Sometimes when you talk to people about inflation, they're like, oh, inflation's not real. 10 years ago, a laptop was $800 and today it's $400. That's because that's one of those products that's outsourced and automated for manufacturing. But things like food, especially fresh produce, fresh fruit, fresh vegetables, it's a lot harder to outsource that and automate that. So those prices have gone up. Next up, this isn't exactly directly stock market related, but China now emits more than the rest of the developed world combined. So we're talking about greenhouse gases. China's emissions of greenhouse gases have more than tripled over the last 3 decades, and now for the first time they exceed those of all developed countries combined. China contributed 27% of global emissions in 2019, far exceeding the US, the second highest emitter at 11%, followed by India at 6.6, the EU at 6.4. Here's the entire OECD, and here's China crossing them in 2019. Now, one thing that I've kind of been surprised by since Biden's presidency, the share price on a lot of green energy stocks has been going down. If I was a betting person, I am a degenerate gambler, to be clear, I just didn't make a bet on this one, I would have said they were going to go up. So this is a bit surprising. Now this is the chart for ICLN, the iShares Global Clean Energy ETF. I just picked this one because it's global and it's more indicative of what my point is. And today we're down to 2160. So this is a significant decrease of 33%. And keep in mind, this is an ETF. So this is a broad basket of clean energy companies. With China now emitting more greenhouse gases than the rest of the OECD, and the fact that China's not really willing to play ball with anybody on regulations, this is kind of heartbreaking in a way. I look at news like this and I see ICLN and all of these green energy companies going down in their price per share, and I'm just like, wow, this is not what I was expecting in any way, shape, or form. I thought like there was going to be a lot of optimism for clean energy companies, for controlling greenhouse gas emissions, but we haven't gotten any of that. More China news. The MSCI China enters a bear market after tech sell-off. Alibaba slumps. Leading decliners include Alibaba, Tencent, and Meituan. I actually don't know how to pronounce this. So Meituan. I don't know. Big tech sell-offs were affecting China just the way they have been affecting the US, and it was leading by their large cap tech stocks. Now the Chinese stock market is very, very tech heavy, just like the US stock market. December to March, COVID time, we had a decline of 20% in the MSCI, and just now, since about February to present, we've had another decline of 20%, which is by anyone's standards bear market territory. The interesting thing here for me was that the Chinese sell-off in tech has kind of mirrored the US sell-off in tech. You know, even though these two countries are at odds with each other in the trade war, are at odds with each other politically, the economies are doing similar things and the stock markets are behaving in similar ways. So it really kind of leads to the idea idea that money is the global language, and these companies are suffering similar fates. Next news story, US senators close to announcing a $52 billion CHIPS funding deal. Man, just look at this. An Intel Tiger Lake chip is displayed. You know, I feel like, no offense to this guy holding this, but they probably could have picked a different hand model here. Cuticles are a mess, the fingernails are too short, it looks like there's some burn scarring here. To be clear, I don't have really great hands. Oh, whatever. Did you guys ever see Zoolander? It was a Ben Stiller comedy from around 2000. The movie was about the male model industry, and it's objectively one of the funniest movies of all time. Remember guys, humor is not subjective. If somebody says something is funny, then it's funny. In this movie, David Duchovny plays a retired hand model. He keeps his hand in like a hermetically sealed glass jar in the movie. I thought that moment was total satire until I saw this picture on the Semiconductor article, and then I realized, oh, maybe we do need hand models. Maybe this is a real career. They're talking about unveiling a $52 billion proposal that would boost US semiconductor chip production and research over 5 years. This technology bill will be part of the Endless Frontier Act, and it's going to invest in the American semiconductor industry, ensure that China pays a price for its predatory actions, and boost advanced manufacturing, innovation, and critical supply chains. This bill was announced on Friday. We had almost a 3% increase in the share price for Intel after this announcement. Intel, of course, is the largest US chips manufacturer. AMD and Nvidia are chips designers, but not manufacturers. And also, Intel recently announced its plan to spend, I believe it was somewhere in the range of $20 billion on its own chip foundry. It's looking like over the next couple years, the US is going to become very competitive in chip manufacturing and not just chip design. Next up, I want to revisit FireEye, the option that I talked about last week. To start, I will say that my position is up 10%. That was not the gain that I was expecting, but a 10% ROI in 1 week on any investment is really incredible. So I still have my option open. I'm probably going to close it early this week before time decay starts to eat at the value of it. I might leave 1 or 2 contracts open in case of a home run here, but I am going to close most of the contracts in FireEye for now. If you're playing an option that's out of the money, so an option that has a price that's higher than the current share price, the closer it gets to the date of that option's expiry, your option starts to lose value because there's less time for the stock to move. So that's what I'm talking about when I say time decay and value. Colonial Pipeline paid hackers nearly $5 million in ransom. Yes, they paid after saying they weren't going to pay. Colonial Pipeline paid nearly $5 million to Eastern European hackers on Friday, contradicting reports that they were not going to pay. The company paid the hefty ransom in difficult to trace cryptocurrency. Monero? Did they pay them in Monero? Within hours after the attack. Once they received the payment, the hackers provided the operator with a decrypting tool to restore its disabled computer network. Cyber sleuths blunted the pipeline hack and choked data flow to Russia. So the US government and some companies within the US actually fought back against this hack, like immediately. A small group of private sector companies, with the help of several US agencies, disrupted ongoing cyber attacks against Colonial Pipeline and more than 24 other victims. We can assume, because they've been dealing with this the entire time, that FireEye was one of these private sector companies, though, to be clear, it has not been officially stated by the US government. They prevented Colonial's data from being sent, so US investigators were able to retrieve it, and after they retrieved the data, DarkSide, the hacking group, says it's shutting down. DarkSide has told associates that it lost access to the infrastructure it uses to run its operations and would be shutting down, citing pressure from law enforcement and from the US, according to security firms FireEye and Intel 471. So not only did the private security firms in the US and the US government recover the data that was stolen from Colonial, but there was a counteroffensive launched on DarkSide, and they lost access to their website, to their server, and it gets even better. DarkSide, the ransomware group behind the pipeline breach, said it's closing up shop after its servers were seized by an unspecified country, and a cryptocurrency account used to pay affiliate affiliates was drained by an outside party. Another country seized their servers, they lost access to their website, their cryptocurrency accounts were drained. I don't even know how that happens. So now they're broke, they're homeless, they got nothing. Apparently they messed with companies in the wrong country. You know, you could do a lot of stuff to Americans, but don't mess with our oil. I think the world knows what happens when people mess with American oil. The culmination of this entire situation, Biden signs an order to boost cybersecurity after pipeline hack. So the order seeks to tighten defenses of agencies and US contractors. Apparently this order's been in the work for months, but it was released less than a week after the ransomware attack on Colonial. And the White House stated that much of the US critical infrastructure is owned and operated by the private sector, and it urged those companies to bolster their own cyber defenses. This executive order is really just a mandate from the US to all of these companies, hey, crack down, lock down, fix your stuff. This entire ransomware attack, by the way, it started because an employee opened an email to see some titties. I'm not joking. Bet you that person gets fired. So in the end here, I still really do like FireEye, but I don't really see much more news coming out of this cycle unless FireEye ends up getting a government contract from that executive order because of the way they responded to the SolarWinds hack and then this one. Next couple of stories, they're also all related. Biden urges employers to boost wages and get people vaccinated. Biden wants the companies to get their employees vaccinated. My expectation is that as our economy comes back, these companies will provide fair wages and safe working environments. By doing so, he said the companies will find plenty of workers and we're all going to come out of this together and better than before. This is kind of weird because we've been talking about the jobs report on this channel and how there's new unemployment claims being filed, but there's also a really tight job market in the United States and a lot of jobs are going unfilled and companies are really struggling to find employees to work their jobs. And a lot of these jobs are kind of entry-level type jobs, low pay, that sort of thing. But when coronavirus hit, the government kind of expanded unemployment benefits. People are kind of taking to these benefits and staying at home as opposed to working at some of these lower end jobs. Biden said the administration will remind US states this week that any unemployed American offered a comparable job must take it or risk losing unemployment benefits. Now, this labor market squeeze is happening because people just don't want to work these entry-level jobs. And a lot of this could be tied to inflation, where they feel like the job compensation is not worth the effort that they're putting in. To combat this, companies are effectively doing what Biden is saying and offering their workers more. But there's a whole lot of corporate shenanigans here where they're increasing the pay to some entry-level jobs, but they're also cutting the overall number of jobs, which means fewer people are going to be employed. And a lot of this is due to outsourcing and automation. It's probably in the end run a net negative, where there's going to be fewer jobs with higher pay and still a lot of people unemployed. Now, I'm not just talking out my butt here. Just in the last couple days, we've had Chipotle hiking wages, debuting referral bonuses in an attempt to hire 20,000 workers. So Chipotle said it'll increase restaurant wages, resulting in a $15 hourly average wage by the end of June. Starting pay for hourly crew members will range from $11 to $18 an hour. They're also introducing employee referral bonuses of $200 for crew members and $750 for apprentices or general managers. The National Federation of Independent Businesses said 44% of small business owners had roles they couldn't fill in April, a record high for the third month straight. NFIB chief economist Bill Dunkelberg said in a statement that some owners are even offering show-up bonuses for those who are hired and report to their new job. That's right, they're giving bonuses just for people that show up after getting hired. So there's really something wrong with the unemployment payments right now versus the possible salaries for people actually working a job. This is a weird disconnect. McDonald's is raising the US workers' pay in company-owned stores. They're raising pay at 650 company-owned stores in the US and encouraging its franchisees, which make up 95% of its restaurant base, to boost pay. Oh, 95% of its restaurant base. Okay. Initially, I was like, oh wow, this is incredible. McDonald's is increasing pay at their stores. But then I realized the company only owns 5% of its stores and it franchises 95%. The company really does not have much say as to what happens in those franchise locations with the pay. So this one isn't as huge of a deal, but still they are trying to boost the wages in their stores because of the labor issues right now. Amazon, Costco, and other big companies have announced pay raises in recent weeks. Amazon is hiring 75,000 workers for North American logistics and fulfillment. The average starting wage is going to be $17 an hour for these workers. And And it's also offering a $1,000 signing bonus and an additional $100 to those who've been vaccinated for COVID. So here, again, we have another company offering a signing bonus for an hourly worker. This is just absurd to me. I can't believe that we're in this position. But Amazon's also increasing their wages and searching for a whole bunch of new people. Last news story this week comes in the form of a tweet. This is from Elon Musk, Tesla, and Bitcoin on May 13th. Tesla has suspended vehicle purchases using Bitcoin. Yeah, that's right. They just started it like a month and a half ago and it's suspended. Shocker. We're concerned about rapidly increasing use of fossil fuels for Bitcoin mining and transactions, especially coal, which has the worst emissions of any fuel. Cryptocurrency is a good idea on many levels, and we believe it has a promising future, but this cannot come at great cost to the environment. Tesla will not be selling any Bitcoin, and we intend to use it for transactions as soon as mining transitions to more sustainable energy. We're also looking at other cryptocurrencies that use less than 1% of Bitcoin's energy per transaction. Oh boy, there is a lot to unpack here. As you can imagine, as soon as Musk tweeted this out, the price of Bitcoin just tanked. I think it dropped like 12% in a day. He's a smart guy, and I have a really tough time believing that he was not aware of the Bitcoin energy usage before the company invested in it. I understand there's some people that are saying it's not as energy inefficient as he's making it out to be, but Bitcoin compared to some other cryptocurrencies is less energy efficient in some regards. Let's just give him credit and say that's what he's talking about, possibly. I don't know. There was also a really crazy idea that I saw that he knew Tesla's first quarter earnings were going to be crap, so he invested into Bitcoin and then tweeted about Bitcoin to drive up the price of Bitcoin. And then if you remember, on the last earnings report, some of their losses were mitigated by the sales of said Bitcoin. So I was reading a lot of comments where people were kind of implying that Elon Musk did a little bit of a pump and dump there on the Bitcoin price to save Tesla's earnings report. I mean, that's kind of crazy. He's already been in trouble with the SEC for his Twitter account. I don't really think he would do that. But, you know, where there's smoke, there's pump and dumps. Also, regarding that ending point there, he said they were looking at cryptocurrencies that use less than 1% of the energy of Bitcoin. Guess what? One of the two cryptocurrencies that I have a pretty large stake in ended up pumping this week right after his tweet. Here's Bitcoin. You can see the 7-day percent. It's down 16%. Ooh, sad graph. Cardano, which is one of the more efficient cryptocurrencies. In that same time period, it's up 38.7% to $2.36 a coin, which is the highest that it's ever been. This is one of those cryptocurrencies that I think there's a pretty strong possibility that Elon Musk would be looking into this one for Tesla payment. As a Cardano holder, I've got all of mine staked right now, earning more. I was so happy to see this. Shift earnings report. Shift triples their revenue in e-commerce unit sales in 2021 quarter one, and they raise their guidance again for 2021. It feels like every time this company has an earnings report, they increase their guidance for 2021. It's like they're just exponentially doing better than expected. They achieved record revenue and units sold levels in the first quarter, year-on-year growth of 254 and 181% respectively. They grew their gross profit per unit, their GPU, to $1,655 and adjusted GPU to $1,690. If you follow the auto industry and you're wondering why these GPUs are low, they're not that low. Keep in mind, Shift sells older used cars, so the gross profit is going to be lower than like selling new cars or newer used cars. These numbers represent sequential quarter-over-quarter growth of 255 and 229% respectively, and they're projecting 285% year-over-year Q2 2021 growth for revenue at the midpoint of the management guidance range. 285% is the midpoint of the range. I don't really need to say much more about these numbers. They're insane. Shift also opened up the San Antonio, Austin markets for sales. They also just started buying cars in Las Vegas to eventually open that market up for sales. The company's growth is astounding. And if you remember at the beginning of the video, I talked about the CPI report and used cars getting a 10% increase in April. That 10% increase, that's not even reflected on this earnings report. This earnings report is January, February, March. So that 10% increase on the CPI report, which is the largest single month growth for used cars of all time, that's going to be on Shift's next earnings report. Guys, I'm loading the bus with even more options on Shift for their next earnings report. I'm going to be looking at some autumn options because I want to stagger them with the last set that I bought. Their next one is going to be even more insane. Let's take a look at the upcoming earnings. This week, there's a lot of Chinese companies. We've got Baidu and JD leading the way with some other ones. We've got the big retailers, Walmart and Target. We've got some former SPACs stocks that make people sad with Clover, Lordstown Motors, and Canoe bag holder checking in. We have C, which is a Singapore-based retailer serving Southeast Asia. Hawkins is a chemical manufacturer which had a spill in March that caused its share price to lose like 50%. So this will be one worth keeping an eye on to see if maybe they are undervalued because of the chemical spill and the fallout from that. We have John Deere, which, you know, it's in the ARKX Space ETF for reasons. And also, I want to take a look for my options play of the week at ZIM and Starbulk, which are dry weight shipping companies. To preface this quickly, dry weight shipping companies are experiencing record profits right now. Demand for goods is really high because supply chains were interrupted during COVID and the world is playing catch up still. It's a seller's market. If you go to AmericanShipper.com and just take a glance at the headlines, Port of LA is on an unprecedented run of busyness. Container shipping rates spiked again. There's a cargo boom driving port busyness. Everything on this website is just increasing prices. We're busier than we can handle. MAERSK, which is the largest global shipping company, just released their earnings report at the beginning of May. I didn't cover this on my channel, but some of the highlights of the report that kind of reflect industry-wide, this was their best quarter ever of business, the best quarter ever in logistics, and the best quarter ever in terms of net profit. MAERSK reported net income of $2.7 billion for quarter one 2021 compared to only $197 million quarter one of 2020. This year's first quarter earnings were not far below their earnings of $2.96 billion for the entirety of last year. That's right, MAERSK in quarter one equaled their entire earnings of 2020 in just 3 months. That is how high the shipping prices are right now. The increase was driven by a 35% rise in freight rates and a 5% increase in volume. So we've got higher rates, higher volume. That's not something that is limited to MAERSK. That's something you can apply to any shipping company. You have other typically smaller carriers that are more exposed to the spot market, the short-term contract market. MAERSK, by comparison, deals with long-term contracts. That's why in some cases they have really extraordinary earnings today, particularly small carriers that are focused on the US market. This was said by the MAERSK CEO. Now, he didn't mention any carriers by name, but that's a good description of carriers like ZIM. So the CEO for MAERSK is kind of giving us an industry insight here and saying that spot shipping companies, companies that deal with short-term contracts like ZIM, which is reporting their earnings this week, are having ludicrous earnings. This is from an industry insider. This is from a CEO. He kind of like leaked this about other companies. So it's not often that we get this kind of insight into the industry. Here's ZIM's website. You could see they service basically the entire world. So they carry dry goods everywhere. They released their 2021 guidance already earlier on the last quarter. And this is kind of funny guidance. It's not really specific. Average freight rate, higher. Average bunker price, higher. Bunker's a special kind of fuel that cargo ships use. It's kind of like what's left over after the more expensive fuels are more refined. Bunkers is like thick sludge, heavily polluting, horrible stuff. It actually has to be heated up before it's used for fuel in these big cargo ships. But that's another tangent, another story, whatever. But they're expecting higher bunker prices, which is actually a net negative. Higher volume though, higher charter rates, which that's the spot contracts the MAERSK CEO was hinting at, an increase in their EBITDA, an increase of their EBIT. I was also mentioning on the earnings report looking at Starbulk carriers, but I'm not very interested in Starbulk because right now they're trading at a PE of 224, which is crazy. I mean, they have a market cap of 2 billion, but if we go to their financials, their net income last quarter was only 27 million. So I don't really want to touch Starbulk carriers. I'm not saying Starbulk won't go up, but this is not really a company that I'd want to invest in with a PE of 224. ZIM, on the other hand, here we go. It just started being traded at the end of January. And since then, we've actually gone up 300%. So yes, I'm about to buy options on a company that's up 300% in a couple months. You know, if you're not interested, you could just turn this off right now. And I totally understand. But if you look at their financials, it's absolutely crazy. Their total revenue, 1.36 billion last quarter. Net income, 366 million. You know, their PE ratio here is 8.6. That's not bad. And their forward PE is 3.8 off a $4.5 billion market cap. The RSI right now, it's kind of hovering in the middle area, 50s to 60s. It's a little high, but we're starting to get a reversal on the MACD here, a bit of a trend reversal. We recently hit a high of $43. That was an all-time high, and we're sitting aftermarket at 39. I'm probably going to be buying some of the July calls. There's only a couple of dates for this because the options are just limited for this company. You have May 21st, which to me, that's too close. That's this Friday. That's a 1 week option on earnings. I don't want to play that game. Then you have July 16th and you have October 15th. I don't really want to pay the maturity price for October 15th. So I think I'm going to go ahead and take a shot on these July options. Right now, the share price is $39 after hours. So I'm probably going to buy the $40 options here, $540 a contract, and I'll probably buy a couple of contracts on this one. So I'm going to buy the just out of the money, basically at the money options here on ZIM. And probably what I'll do is if it spikes after earnings, then I'll sell off half the position right there to lock in some profits and then carry the other ones a little bit closer to expiry. That's it for the video today. I hope you enjoyed it. As always, if you're new to investing and you want to support the channel, check out my Webull referral link below the video. If you use that referral link, sign up for an account, deposit $100, you get a free stock, I get a free stock, everybody wins. Webull is the really cool app that I'm using for data aggregation and for all of my charting that you see on the video today. As always, if you enjoyed the video, please like the video, subscribe to the channel if you want to be alerted to all my content. As soon as it goes live, make sure you hit that notification bell. All right, everybody, thanks a lot. Good luck investing. Stay safe.